All right, so we are live. This is Consumer Protection 101, brought to you by Edward Araujo, presented by Edward Araujo from Texas Consumer Credit Services, and brought to you by the Nesting Realty Group. Just going to give a second to introduce each one of us. I am Thomas Folden, and I'm a residential realtor here in El Paso. And I'll introduce Rosie Carrasco. Go ahead, Rosie.
Hi guys, good morning. I hope everybody's doing well and keeping safe in their homes. We're going to be presenting, an episode about credit. So if you guys have questions, please drop them in the comments and we'll make sure to answer them as they go by.
All right, awesome. And Rosie is also with the Nesting Realty Group. She is a residential realtor here in El Paso, if you didn't know. And we also have Jorge Macias. He's a residential realtor here in El Paso as well. Go ahead, Jorge.
Hi guys, hope you guys are doing well during this quarantine time. We're here bringing you that presentation as mentioned by Rosie. If you guys have any questions, feel free to drop them in my inbox as well.
All right, awesome. And then finally, we got Edward Araujo from Texas Consumer Credit Services. How are you today?
Doing good. How you doing?
Doing great. Feeling a little bit rocky from the minor earthquake here. Felt like the wind was shaking the whole house and stuff like that. And we see everybody posting on Facebook about it. So we know it was real. And what we saw is like a 4.7 little mini earthquake here.
Wow. Well, it's nothing surprising nowadays. So
yeah, absolutely.
Okay. For those of you that don't know, my name is Edward Araujo. I'm president of Texas Consumer Credit Services. I'm also the author of this book right here called Credit Decoded. I've been in the financial and services industry, credit industry for quite some time, over 10 years. And really with the focus on credit, consumer side, business side, but really what we're focusing on today is consumer credit and really 101 and the basics. I work with a lot of the real estate agents, mortgage lenders, when it comes to credit and people trying to qualify for homes. And really with everything going on, with the crisis and everything, your credit is going to only become more important. So that's kind of what I wanted to talk about today. We're going to get into just some basics. I know we're also going to have Thomas and some of the people on here. They're also experts in their field. So we'll kind of go back and forth on a couple things. I think we're going to be monitoring, right, Thomas? If people have questions, they can chime in. And I know we'll maybe have like a Q&A a little bit at the end, or feel free to really chime in at any time. I'm going to go over some basics, but if you guys have questions, things you heard, by all means, chime in. I'd be glad to answer any questions you have a discussion about anything that, that you may have been wondering.
Great. Yes, we do have Rosie and Jorge and myself also monitoring the chat. So if you do have a question, pop it in the chat box. And then when we have a little break in the conversation or the presentation, we'll start pulling out each and every one of those questions. And then additionally, we want to make sure that everybody knows that you have an opportunity to, after this, schedule a one-on-one with Edward and his team so that you can have a private conversation if you have some sensitive material that you want to talk about. So yes, absolutely.
Definitely. All right. So I always like to make sure everybody on Facebook, we're doing a kind of a group thing here, can hear. If you guys can hear, press 1. If you guys can see us, press 2. And if you can hear and see us, put a 3 if you can in the chat. That way we know we're not just talking to ourselves here. Okay. So what I like to start off with is, I don't know if anyone has ever checked their credit score and then checked it somewhere else, and you've got all these different credit scores, right? If that's ever happened to you, put a thumbs up or something. And I get, that's one of the main questions I get, and that's kind of where I want to start is, credit scores and which one is the right one and why is this one different? And the truth is we have hundreds of credit scores. Okay, so we have different versions of your score. If you apply at the very same time for a house, a credit card, and a car, they're all going to be different. Okay, there's different versions. So for example, you have FICO, you have Vantage. Within FICO, you have from like version 2 all the way on up to coming to version 10, To make it even more confusing, within version 2, there's an insurance score, an auto score. So there's all these different scores. And the reason there's these different scores is because you may be a greater or more of a risk for a certain type of credit line or whatever you're trying to get. So for example, you may be more of a credit risk for a vehicle if you've had a repo versus always paying your credit cards on time and having low balances. So that's why your scores may vary. And there's different scales. For example, they go from 300 to 850. Some go from 200 to 900. Some big companies like Navy Federal, I believe, even have their own proprietary credit score. Okay. So what I like to tell people is there's no correct one. The correct one is going to be whatever they're using. For example, when you're trying to get a mortgage, they use FICO scores that are over 20 years old. If you ever see a mortgage report, it'll tell you exactly on there, FICO 2, Beacon 5, whatever it may be. So what I like to focus on is what makes up your credit score, okay? Because all of your data, all the information, your credit report is the same. It just depends what scale they're weighing it on, what version they're using. And there's some general rules that affect all of those scores with a little bit, variances where they'll affect a little bit more than the other. So there's 5 main parts that make up your credit score. Okay, and I like people to remember this. So we want to remember 35, 30, 15, 10, and 10. Okay, so if you want to think about a pie chart, those are going to be the percentages. Okay, the 5 parts.
Yeah, can you run through those numbers one more time?
So it's going to be 35, 30, 15, 10, and 10.
Gotcha.
All right. So I want to think of this as a pie or a pie chart. So that the biggest piece, that 35%, okay, is going to be what is considered payment history. Okay. So your payment history. Payment history is the biggest determining factor in your credit score. Okay, so there's a couple different things that come into play when we're thinking about payment history. So that's going to, obviously, paying all your bills on time is the biggest part. But it's not the only thing, okay? So that's why it's important to remember. So we're talking about on-time payments. So obviously, what's going to start impacting your scores if you have late payments. How late? How many lates? How many accounts with late payments? How many with not? Do you have collections, charge-offs, bankruptcies? All of those negative accounts are the major things that are going to impact your credit score. So most people know that, right? Like if you have a collection, if you've had a car repo, your credit's gonna take a hit, right? What I want people to realize, though, is that it's a lot more than that. Even though it is 35%, which is, if you do some math, and all the numbers that I'm going to talk about, they're not exact because your credit score is just a big formula and there's a lot of things going on. But for example, most scores, like your mortgage scores, go from 300 to 850, right? And, good credit, 700 or above to get a home somewhere in the 600s. So let's kind of break it down a little bit. So 35%, if you go from 300 to 850, you got about 550 points available, okay? So 35% of that is about 192. Okay, so what I mean by that is your payment history accounts for about 192 points roughly. Now, the reason that's important is because I get a lot of clients that say all the time, well, all you have to do again is just pay your bills on time. You have good credit. Well, if you paid all of your accounts on time, never missed a payment, but you didn't pay attention to any of those 4 other parts, the best score you could have is still around a 492. Right? Because you add that 192 to about 300. So even though this is important, we also want to go over the other 4 parts. Okay. So yes, that is going to be your biggest part, right? And that's really where we focus on with people, charge-offs, collections, and things like that. Now, the next part is 30. And that's where a lot of people overlook, right? Everyone, payment history and all that. And it's called a lot of different things. And there's a lot of misconceptions about it. It's really what I call balance and burden or indebtedness. Okay. A lot of people call it utilization. Really what it is you have 2 main types of accounts on your credit report, installment and revolving. Okay. Revolving being like a credit card or credit line, something that has a credit limit. and a balance, and you can use it and pay it down. An installment is going to be something that has set payments or a term, like a mortgage or a vehicle, right? It's $350 for 72 months or whatever the case may be. Out of that 30%, so pretend we have that piece, right? That 30%. Of that 30%, if we split that in half, about 95, the majority of that is your utilization, which is credit cards. Okay. So when you have a credit card, again, you have a limit and a balance. The percentage of that available credit you're using is called your utilization ratio. So to make the numbers easy, if you have $1,000 limit credit card and you have a $500 balance, you're using 50%, right? Mm-hmm. So there's a couple things you want to remember. If you're ever using more than 30%, so if on that $1,000 card your balance is over 300, you're hurting your score. Okay. Mm-hmm. And remember, this is a big part of your score. I've seen scores fluctuate 50 to even 100 points. Again, not missing any payments, right? Just maxing out that credit card. So it's super important. Ideally, you want to have your utilization ratio below 10%. Okay. So what does that mean? What we coach our clients on is that same $1,000 credit card. You want to put in your head that your limit is only $100. Okay. Right. Forget about the loan. Just pretend it's only $100 and never use over 100. And I don't mean use 500 and then pay down to 4. Just pretend there's only $100 on there. Okay. That's one of the first things I look at on a credit report is that utilization, because that's something that you have immediate control over, that you know that if you pay that down, your score will adjust. Okay. And ideally you should have 3 credit cards. So that's the key number, 3 credit cards with utilization under 10%. Now, your limit doesn't necessarily impact your score. Someone has $1,000 limit or a $10,000 limit. That's not what impacts your score. It's how much of that you're using. Someone can have a $10,000 card and have it maxed out, and someone can have a $1,000 card but only a $50 balance. And the one that has that lower utilization, more times than not, is going to have a better credit score. Okay, so it's yes.
Okay, we had a question really quick. I didn't mean to interrupt you, but Peter,
of course.
Peter wants to know, how long does the collection stay on your report, and can it be disputed?
Okay, that's a great question. So there's a law called the FCRA, the Fair Credit Reporting Act, that states an account like a collection can be on your credit report 7 years from the date of first default. So which means 7 years basically, right, from when it went delinquent. That cannot be restarted, contrary to a lot of things that I hear. Okay, if they sell it to a collection company, it's 7 years. Okay. Anything on your credit report can be disputed. But here's where the confusion comes in. You have to have a reason. You can't dispute something because you don't like it and it's hurting your credit. And that's where a lot of confusion comes in with people disputing things on Credit Karma and things like that. The way when you dispute something, there has to be a reason. Something has to be wrong with it, or something has to be questionable on it, or can't be verified. And that's where like a professional comes in. Now, anyone can repair their credit and anyone can dispute anything, right? But most consumers, you're going to dispute it's not the right balance, it's a wrong date, it's not mine, whatever the case may be. But there's all of these laws, there's over 200 laws that these creditors, anyone reporting, a collection agency or creditor on your credit report, have to follow. And that's where a professional comes in. Even though it may be yours, even though the balance is right, if it's not abiding by some of those other laws, you can dispute it that way. Okay. So yes, anything can be disputed. You just have to have a reason. You can't just dispute it. And if it is yours, I know there's a lot of information out there that say, just say it's not yours. And if they can't verify it, okay, do not ever do that. Nothing about credit repair, improving your credit involves lying or trying to skirt the truth. Okay. It's only going to hurt you. That's fraud, basically, if the account is yours and you're saying it's not yours, right? The goal is to find issues. When you dig deep enough, more than likely, a lot of times there are. It's just knowing what to look for. Okay. So yes, 7 years, and yes, you can dispute anything on your credit report. A collection, a late payment, a bankruptcy, a charge off, a repossession, whatever. Anything that's reporting on your credit report. Okay. So that's a great question. We do get that a lot. So going back to we were on part 2, right, of your credit, the 30%. So the majority of that is your credit cards. Okay, if you don't have any credit cards, we hear this a lot. Sometimes a lot of the people, the clients that I consult with, they're happy or proud that they don't have a credit card. Okay, which is good and bad. The thing is, when you don't have a credit card, you can be hurting your score because they don't have anything to measure you off of. Okay, so it may be good for budgeting. The thing is, they want to see that you can have a credit card and be responsible. That's what helps your credit score. And I can help, my team can help with that. And that's what we help clients with, coaching on how to get them, because you can't go out and get a American Express Platinum if you don't have any credit yet. So there's a building process, right? You can start with a secured card. There's certain types of card. I think we're even going to provide them, right, with I have like a guaranteed approval guide with starter credit cards that will approve you, and we show you how to use them. Now, remember, we said they're still installment loans, right? But really, installment loans, believe it or not, other than the mortgage, have a little impact. Now, obviously, paying payments is the part, but I'm talking about balances. So the balance on your installment loans, the balance on your personal loan you took out on your vehicle, have very, very little impact on your credit score. Okay, so what I mean is, like, paying a car off early or giving more than the minimum doesn't really improve your credit score. It may be better for your financial situation, save on some interest, but it's really the balances on credit cards. So if you have $1,000 and you're trying to look at how to improve your credit score, it would better be, sir, a better way to use it would be if you have a maxed out credit card versus like giving a double payment on your car. Okay, and again, I'm addressing these as how they impact your score, not that it may be better to pay that car off so you don't have that payment and save some interest. Okay. If you're applying for a mortgage, we really want to look at it because maybe you may need to pay that to be able to get into the house that you want. Okay. But that's the important thing. So those 2 parts make up 65% of your score. Okay. So having on-time payments and having at least 3 credit cards, obviously with on-time payments, but below 10% is ideal. Okay. Now, the third part is age of file or age of credit. Okay, it's 15% of your score. There's not a lot you can do to change your age. There's a couple things you can do, right? One of the things you can do is not always be applying for new credit. Okay, because if you have one account that's 5 years old and you took out 5 loans or whatever it may be in a year, well, obviously that average, because there's an average and then there's the age of your oldest account, right? So it's going to bring down that average. So people are constantly applying and getting new loans, new credit. Well, obviously it's going to bring down that average. You can, and I want to make sure I preface this correctly, you can add what they call, or you can be added, I should say, as an authorized user to someone's card. Okay. But this is very, very important. You can be added to someone that is basically like within arm's reach, or if a mortgage company were to ask you, is that your brother, your friend, whatever the case may be, that is fine, right? I did that with my little brother. I added him to one of my credit cards when he was 18. He had a 700 and something credit score because all that history, the payment history, the age, the utilization shows up on their credit report. Okay. Now, where we get into problems, because I see this on social media and everywhere, is we just talked about those 2 biggest parts of your score, right? So obviously if you had someone to a 20-year credit card with perfect payment history, low utilization, boom, their score is going to jump up, right? There's no question. What happens is that there's a lot of this misinformation out there going on about piggybacking, buying trade lines and these things. And what happens is there's people that find people with good credit cards, and they say, hey, we'll actually pay you for every person you let us add. Okay. And then they turn around and people that need credit, have high utilization, don't have any credit, and say, hey, pay us X amount of dollars and we're going to add you to this card. And boom, overnight, as soon as that card reports on your credit report, your score is going to go up. Okay. Well, it's basically illegal to do that. Okay. It's illegal even if you charge your brother to do it, right? It goes against a lot of those terms and conditions in credit card agreements. If you're trying to get a mortgage and you're doing that, it can be construed as mortgage fraud. There's all these things that are going on. Just because not everyone gets caught doesn't make it illegal, ethical, or right. Okay? So if it sounds too good to be true, it probably is. Okay? So just look out for that. If anyone has any questions, I'd be glad to help on that.
Yeah, man, that's wild. I've never heard that people do that. That's crazy.
Yeah, they disguise it as credit boosting techniques. There's there's a lot of great companies like mine, credit repair companies. We're not the only one. I've got a lot of friends in the industry, but there are always some bad apples, right? Especially with social media and everything, and someone looking for a quick fix, and these companies are taking advantage of people that are in a situation like that. And you'll hear it, and they'll actually sell them, and they say they're credit repair companies or whatever it may be. So just look out for that. That's one of the things I tell people about. Okay, that's one of the ways you could increase your age. But age is pretty basic, right? Don't always be opening new accounts. Now, one of the things that I hear a lot about age also is, has anybody ever heard when you don't close a credit card, right? Don't close it. And it is true, you shouldn't. But the reason you shouldn't, sometimes people misunderstand that. A lot of times people think don't close it because you're going to lose the age on that card, right? You actually don't. Okay. As long as there's an open date on your credit report, even though the account is closed or open, it's being calculated. Okay. Usually what happens when you close a credit card is we impact that other part we were talking about, right? You take away that $5,000 of available credit that you had. Now the two other $200 credit cards you had, yeah, they weren't being affected. You were maxing them out and you didn't feel it because you had that other $5,000 there to help you, right? Because they measure you by card and then your overall utilization. Right. So if you had a $5,000 card and then two small little $200 cards, well, yeah, you're maxing those out, but your overall is always still low. You take that card away, now you go to 100% and your score goes down. Okay. But general rule of thumb is not close them if you don't need to. Maybe just stash them away or whatever the case may be. Okay. The two last parts are 10 and 10. Okay. So they are small, but nonetheless, they're 10%. Right? Could potentially be 50 points, 40, 50 points. So one is credit mix or diversity. Okay. So they want to see the algorithm, that's what your score is, an algorithm or a formula, wants to see that you are responsible with different types of accounts, whether that be a mortgage, an auto installment, a retail credit card, a personal loan. So they want to see, for example, ideally, a person that's diversified would have a mortgage, a vehicle, has maybe had a personal loan, and has 3 credit cards. Okay, so that's one of the things you want to look at. So, for example, I had a client that was super excited because they paid off their car, right? And then his score went down. I was wondering, I just paid off my car. Why would my score go down? Well, what happened was that was the only installment account on his credit report. He didn't have a mortgage. He didn't have a student loan. He didn't have a personal loan. So now he lost that small, like his score didn't drop a whole bunch, right? But it was like 20 points or something because he didn't have an open installment account. Okay. So some things that impact your credit kind of contradict financial, things that you're looking at to save money. But again, remember your credit is just measuring. Really, all your credit score is doing is giving you the likelihood of if you'll go late on an account within the next 2 years. Okay. So it's just diversity, right? So that's something we coach our clients on. There's ways to add. Now, building your credit and having these credit cards doesn't mean you have to go into debt. That's a big misconception. Okay. You can have a credit card and only put a reoccurring charge on it like your Netflix, pay it off every month, pay 0 interest. You're not in debt, right? And you can do that on 3 cards, okay? You can get a credit builder loan that it's almost like a savings account where you're paying $20 a month and you get a certain amount of it back. So you don't have to go into debt to have good credit. That's a misconception. You just need to know how to manage it correctly, okay? So that's 10%. That's your mixed credit mix, or diversity. The last one it's kind of an interesting one, and it's new credit or inquiries. Okay. Sometimes I do a whole section and get into depth on this because inquiries are one of the things that I get the most questions on and are most understood. Okay. We know what an inquiry is, right? If you don't know what an inquiry is when you apply for something and they basically check your credit. Okay. You have soft inquiries and you have hard inquiries. Hard inquiries are the ones that most people are usually familiar with that hurt or can hurt your credit. And that is when someone has permissible purpose. Basically, when you're applying for something, a cell phone, a car, a mortgage. Soft inquiry is what's called a promotional, or soft inquiry is when it doesn't hurt your credit. So when you check your own credit, right? Credit Karma, or you pull your own credit report, that doesn't hurt you. A lot of times when you get pre-approved offers, it's a soft inquiry. They only use like your last four of your social or limited data. Those are soft inquiries. Okay. So let's focus up for a little bit on hard inquiries. I always get asked, how many points will my score drop per inquiry? Right? Has anybody ever asked you guys that? Because people worry about that, right? Like, hey, I don't want to pull my credit at the mortgage company.
Right.
Right.
So, like, can you tell us, like, okay, so like, let's just say somebody is shopping for a mortgage, right? How many? I heard it was like about 45 days before their credit started going down. Is that true, or?
That's a great question. So it's called there's what's called a deduping period. Okay. With mortgages, cars, and student loans, those three types of accounts, what happens is they dedupe them, or basically it's just a fancy word for grouping them together, which means you can go to 5 car dealerships, 10 mortgage companies, and each mortgage, even though you got 10 mortgage inquiries, they're going to get grouped together and weighed like as one. Okay. And there's time frames for that. Now, the time frame depends on what score version they're using. Okay. There's some versions that only group them within 2 weeks. There's some that do 30 days, and there's some that go all the way up to 45 days. I believe, don't quote me if I'm not mistaken, though, mortgage, it should be 45 days. Okay. Obviously, if you wanted to be totally on the safe side, you could do 2 weeks. Now, what that means, that doesn't mean they hurt you or they don't. It just means that all those inquiries that are in that 45-day group are grouped together. So let's say you did 10 in those 45 days, and then on day 50, you did another one, you'd have like 2 groups. Okay. That's what that means. So that's a great question, because a lot of people say, I don't want to go to another mortgage company, or when they're shopping for a vehicle, they're going to send it to a bunch of banks. It's fine. Okay. Because they're basically going to be grouped together. Now, if you're going every month and doing, well, then you're going to have those many groups, right? But it's only for those 3. Okay.
Let's just say, like, because people have, like, I mean, people think, oh, well, my credit's going to drop a lot. What would be like the percentage that it would drop if they did those inquiries within those 45 days?
That
Or just depends.
It depends. It's a really hard question to answer. It's kind of like saying, if I do 10 push-ups a day, how much weight would I lose, right? Well, it's going to depend on how you eat and all these other things. So this is the way I like to look at it. And in my seminars, this is the way kind of how I ask people. I ask people, like, who likes to have a drink here and there? And someone will raise their hand, and I'll say, okay, for example, Rosie, if you drank 40 margaritas today, would you be inebriated? Would you be drunk, right? Most people are like, yeah, of course. Okay. But what, right?
Yes.
But what if I told you you're going to drink one every other day for 80 days? Okay. So it depends. It's going to depend on how many of them, how far apart, how many other types of inquiries. So I've seen this happen. I've seen nothing happen. I've seen 2, 3, 4, 5 points happen. I've seen 20 points happen. Okay. Really, it shouldn't be more than about 50 points, even if you did like 1 million inquiries, because remember, it's only 10% of that whole score. So potentially it could go that much. That's rare though, right? General rule is don't be scared of inquiries, but just use almost common sense, right? Not every time you're at Target or a store and they offer you the card, you're applying. If you are, it's when you're going to go, you're actually serious, you're going to buy a vehicle, do that. Credit cards and those, again, those are when one by one. The good thing about inquiries, though, again, it's only 10% of your score. They only impact your score for 1 year. Okay, so after a year, it's not being factored into your score anymore. It will stay on your credit report, or should stay on for 2 years. You'll see it on the credit report, but it shouldn't be having an impact on your score. Okay. Now, a thing about inquiries, I'm talking about how they impact your score, but one thing I always like to tell people is your score doesn't get you approved. Your score gets you denied. Okay. What I mean by that is right off the bat, if your score's not there, you're denied, right? They don't even look at anything else. Your score gets you to a point where you can be approved. Okay. For example, you all deal with mortgages and home buying. Someone can have a perfect credit score, but if they make minimum wage, they can't just go buy whichever house they want, right? Because you've got all these other factors that the mortgage company's gonna have to look at, employment and things like that. So inquiries, even though they don't impact your score a lot, they can impact your chances of approval. Okay. When you're making a major purchase like a home or things like that, if they see a lot of inquiries, that can be a red flag. Like, why did you apply for 10 personal loans? Is there something we're not seeing, a potential job loss coming or something? So they are important, right? You don't want to be applying everywhere, even though they're only 10% of your score, but more so for approval odds. There's some places that don't want to see any inquiries within the last 6 months, or limited inquiries. When you're applying for credit cards and when you start getting into applying for higher tier cards, like let's say a Chase Sapphire card, American Express, they don't want to see a bunch of other, by the time you've got to them, you've applied for all these other cards. Okay. So that's a great question. And that's kind of how those inquiries impact you. Okay. So as you can see, since you have all these 5 parts, it's very hard when someone asks, well, how can I raise my credit score? Well, we know some general things. Do you have high credit card balances, bring them down, or payments on time? But really, it's always a case-by-case scenario. It's like a doctor has to diagnose your situation to give you a prescription, right? I want to look at the credit report because there can be a lot of things going on. Your credit report's like a fingerprint, right? Everyone is different, but there's some general ideas that, rule of thumb. You should obviously make your payments on time, keep low credit card balances, don't always be applying for everything. And then you can get into specifics on your credit report. And that's what we help people with, right? Helping them know how to manage their credit. That's the most important thing, is the education and knowing how to manage it, because they don't teach us a lot of these things in school, right? Most people don't know their utilization, don't know those things, but yet they impact us every day. So for example, credit in this crisis that we're going through now, right? If you had credit, you could potentially use it now. Yes, your score may go down, right? If you max out your credit card, but it's going to get you through. And then yes, when you get back on your feet, you're going to pay it down and your score is going to go back up. But that's it's important to have good credit. If you need to go get a loan right now, aside from maybe the assistance that we may get, you could go maybe no questions asked and get one. Right? So credit is important for financial security and financial freedom as well. How was that? Did you guys learn anything new? Or and that's like on a real basic, right? Like the 5 parts of your score. But a lot of people don't really even know those 5 parts.
Right. No, yeah, it was very informative. I think, with the basics, I think everybody should already, we should have like the basic knowledge, and then from there we can go ahead and, whatever it is that they want to build their credit for is pretty. So do you guys have any other questions that you guys want to ask Edward while he's here?
Yeah, I got a couple that I wrote down, just kind of along, because it's credit 101. I don't want to assume that everybody out there knows the answer. So just a couple of questions from me. What is considered good credit, fair credit, bad credit? Maybe industry standard. What are those numbers to me?
Yeah. So I like to use kind of like most of the things we're buying are like vehicles and houses, right? So I kind of like to use that. So what I consider good credit, and what most institutions consider or great credit, like top tier, A plus, like when you go to the car dealership, that's the best rate, a home best rate, is like 720 or 740 and above. Okay. Now we're talking about not good. We're talking about like you made it to the top, right? The difference from a 740 to like a 780 and 800 is very minimal. Okay. That's where you'll start seeing, if you go to a car dealership, you get that, what they show on the commercial, right? You get the 0.9, whatever it may be. Okay. For some mortgages and stuff like a 680 or above. So I like to get people to what I call the 700 club, right? That's great credit. Okay. Good or fair credit is going to be like 640 to somewhere around in the 700s usually. Okay. A lot of times people think they have great credit because they qualified for a home at a 620 or 640. That's like you just qualified, right? Like you barely made it. That's not great credit. But if you have credit around there, so 700 club, 720, 740 and above, that's prime rates, everything, right? 620-ish, 640-ish to 7, you're going to get approved. You may have some contingencies. You may need a down payment. You may need different things, reserves. Other things may come into play, how much you make, your income, expenses, debt, like that, right? Really 620 below or 600 and below is where you're going to have difficulty, okay? That's where you may get approved, right? We hear some 580 loans, and a lot of the car dealerships will approve you 500, whatever it may be, but you're going to pay. You're going to pay for it. You're going to pay in the form of higher interest, higher down payment, whatever it may be. And that's where a lot of people get stuck, right? Almost like on a vicious cycle where they're getting these high interest car loans for 6-7 years, and then they refi it, and before they know it, their car's worth $10,000 and they owe $25 on it, right?
Yeah.
So it's not always of if you get approved, it's your rate and those things. So really, 600 and below, obviously we've had clients in the 4s and those. And sometimes there's a difference between two people that have 550. Okay. There may be a person that has 550 because they have a bunch of collections. There may be a person that has a 550 because they only have one collection but maxed out credit cards. There may be a person that has a 550 because they have limited credit. So those are different instances where there's someone that has 20 collections may be a little more difficult than someone that just needs to add or establish some credit. Right? So again, that's why the score is important, but it's different. Two people that weigh 150 pounds, one can be healthy, one not. Maybe there's a different story behind that. Right? So yeah, that's kind of the way I look at it. So I really look at it as 5, 6, and 7s.
Got it.
Right? Like awesome. As a general type of thing. A lot of times a client will ask us, can I get approved here? We'll never know if you'll get approved for anything because wherever you're applying, they have their own criteria, right? But you want to just focus on those 5 parts. Focus on those 5 parts. Your score is gonna increase. Not only your score, but you'll have a healthy profile.
Nice.
Okay. So yeah.
How can I check my own credit?
Okay. So there's a lot of ways you can check your own credit. Everyone knows Credit Karma. I personally don't like Credit Karma. Not just because I don't like them, but for a couple reasons. First of all, they're not a credit monitoring company. Okay, that's not their goal. They're an affiliate marketing company, which means they make their money off of affiliate income. So if you ever notice when you're on there, you get a bunch of recommendations, right? Some of those recommendations may not actually be the best recommendation for you. It may be best for them.
Right.
Okay. Now it's kind of a good tool. Don't understand me. Anything's better than nothing, right? Go on there, check it. You kind of get an idea, but it's sometimes not accurate. A lot of times not accurate. And it doesn't have a lot of data on there. So it's good to maybe step in. You should, I'm a big advocate of having a paid credit monitoring service. Okay. I'll give you guys some links here when we're done also if you want to put them on there. And the reason is, in this day of credit, everything being online, you want to be monitoring it. So you want to have accurate data. Now, don't worry about the score so much because there's going to be Vantage scores. There's going to be these. It's more about looking at your report, right, to what's on there. We use one, and I'll put the link on there. It's
All right, so we're back here. We realized we went a little bit over time. Want to make sure that we catch you up just a little bit. And then also let you know what's going on for for next week. Some of the questions that we had that might have got cut off is, should I pay off my credit card, cancel it, or leave it active and not use it? It was leave it active and not use it. And then Rosie, do me a favor. Can you ask that one question you asked about, basically our current situation and how it affects credit and me not being able to pay? Can you ask that question one more time? Let Edward answer it.
Oh, yes. So I was asking what people should do in the meantime if they're laid off and have credit cards pending.
Okay. And there was three main things. The first one was call your creditors. Call your credit card company. Call where you have your car loan. A lot of them have programs in place where they're deferring payments. I know I've confirmed a couple of them. I know like Evolve, because one of my clients personally did it, deferring the payment automatically, no questions asked. And they said they could, I think, do it up to 6 months. They put it at the end. So that'll avoid, that expense. But you have to call them before your payment is due, not after you're late. Okay. You want to ask if you have credit cards for credit limit increases. So maybe you can have some credit if you do have limited funds. And if you do have to use your credit, if you have a higher limit, it's going to decrease how much it will impact you. And the last thing was kind of prioritizing your bills. A lot of people don't know that something cannot legally by law be counted as late on your credit report until after 30 days. So at day 31. So if you need to delay a payment out for 2 weeks because you need to buy toilet paper or whatever it may be, you can do that without it impacting your credit score. And certain things like your utilities and things that aren't already on your credit report won't show up just because you're late. Those don't show up until they go to like collections, and most times cell phone bills, things like that. The main thing I would say is reach out to your creditors. There's assistance out there, but you have to ask for it, basically.
Great. Awesome. Thanks. The last question I think that we had is just basically give us an idea of what we can expect on the next video.
Yeah. So I know today we kind of covered what makes up your credit score and, how it works. So next time what I want to do is now, inquiries, if you have collections. I'm going to go over, if you're already there, what can you do to improve your credit? What can you do to fix it on your own? There's a lot of little strategies, tricks, things that you can do, that you can implement that day. So I'm going to go over the basics of that, things that you can take, and right after that, be able to do things on your credit.
Awesome. Edward, thanks again. And we're going to make sure that we post the links in both of the lives, just in case, people don't see one, they get it on both of them. But we do want to make sure that people know how to reach out to you and benefit from the services that you provide.
Yeah. And share it. I would ask that people share it with your friends, your family. Some of this information, it may help them. It may save. There may be people out there right now stressing. I had a client, I'm telling you, they were going to be 3 days late. And I mean, they were stressing. I mean, it was affecting them, so get the information out there, share it, share the live, tag people. If you've got questions, I think we should let them, I think you can still ask questions and we'll monitor it. And I'll try to go back if I'm on there and answer them in the comments. If not, we'll address them next time we're live or something. So
absolutely.
Yeah, for sure. And then we are going to be probably post our next episode, which would probably be next week, hopefully by Tuesday, if not by Thursday. But what will we be covering again, Edward, just so that they missed it the first time?
I'm going to be going over how you can improve, build, or fix your credit. So I would recommend they even come and watch our live that we did today, the previous one, to kind of know how your score works. And then if you find yourself in some of those situations, bring questions to that live. But I'm going to be showing you things that you can do on your own and implement ASAP that very day.
Okay, great. Well, thank you, Edward, so much for your time. I really appreciate you.
Oh, thank you all.
Yes, thank you, Edward.
All right, let me close this thing out, and then let's hang out just for...
You're on mute, Thomas.
Thanks, appreciate that. Hey, let me close this thing out, and let's all just hang out for a minute so we can make sure that we get everything posted correctly.